Hi and welcome back to our lecture on financial risk management. Last week we stopped with our discussion of liquidity risk and we'll now turn to I would say the third most important type of risk in any financial institution, which is operational risk. Operational risk is a little bit different from market risk and liquidity risk and credit risk in the sense that it is not as easy to define, and that is because it is actually defined as the remainder of anything else that is not market and credit or liquidity risks. At least that's how it came into existence in the Basel banking regulation. What is operational risk? First of all, we have to see that so far the common denominator of all the risk types we've discussed so far was that they had an exogenous character, in the sense that something happened outside of the financial institution and this event caused risk exposure in the bank, for example. So we have an exchange rate, the exchange rate changes adversely, we have a market price, we have a stock price, we have a default probability, and because of these changes or something that is going on outside the company, we have a higher or lower risk exposure of our financial institution. And second, usually those risks were related to the core business of the firm. For example, our lending business, our trading business. However, financial risk can also arise from exogenous, endogenous events. For example, we have an own employee who does something that might affect our risk exposure. We have bad internal processes. We have a failure in our internal IT system. So something endogenously happens, or we have an exogenous effect on an area that does not belong to the core business or is not related to the core business. For example, we could have an IT problem or a power shortage in our call center. Now, the call center, the service center, is not so important to us. So this should not be a problem to operate our business without the call center for a day or two, but at some point it will affect our profits. So this is a non-core area maybe of our financial institution. And especially in the first case, exogenous events, natural catastrophes, disasters, unexpected major losses can arise and even cause a financial institution to go bankrupt, even though financial institutions offer financial services and not really physical products. So if risk management has previously only monitored and controlled risks in the core, not in the cores of business, in the core business, let me just mark this, if risk management was only concerned, for example, with lending and trading, it might be that your risk managers have missed out those risk exposures in those non-core business areas, like, for example, the IT service center or the IT system as a whole. And in the past, these risks were considered being thus just the residual of overall risks. You had market risk, you had a credit risk, and everything else. And of course, you had to care about everything else, but it wasn't defined and it wasn't given a name. So in Basel II regulation, around in the mid-2000s, Basel II banking regulation came about and said, okay, we have to, first of all, define what is this residual of overall risk. What else do we have besides market risk and credit risk? And what then happened is, this was called operational risk, operationelles Risikomanagement, operationelles Risiko, op-risk, operational risk. And this was first defined in Basel II. And as you might know, this Basel II framework is a supranational framework and actually just a recommendation for national countries to adopt this. And it was adopted and introduced into German law by paragraph 269, section 1 of the Solvabilitätsverordnung, so the executive order concerning the solvency of financial institutions in English. So what's the definition? This is the English definition. Of course, the solvency order, Solvabilitätsverordnung, is in German, but this is the English translation. Operational risk is the risk of losses arising as a result of, first of all, inadequacy or failure of internal procedures, systems, people, or as a result of external events, and this definition includes legal risk. So what you can see is, it's everything. It's the inadequacy or failure of an internal procedure, could be anything, internal system, this includes IT, service center, but anything else, any system, people, inadequacy or failure of people. Usually these are peoples who, employees who are doing something illegally, people who are stealing, people who are acting on their own, rogue traders is a prime example of the inadequacy of people. But again, every time an employee does something that is detrimental to the company, this will be considered an operational risk or as a result of external events. Now, external events, you could think now, okay, we've just seen that external events cause market and credit risk. That's not the type of external events we are thinking about here. We are thinking of natural disasters, catastrophes, and these sorts of things, which might have an effect on our operations and might slow down or cause a problem in our banking operations. So the definition of operational risk does not contain strategic risks or rep risk, reputational risk. This is slightly different in Solvency II, the analogy to Basel II. Now, strategic risk would be that, for example, the bank does something wrong strategically. It offers the wrong services. It is not able to assess the market. That would be strategic risk. And operational risk is not strategic risk. It's not the risk that you have bad management. Reputational risk, you can argue whether reputational risk is part of operational risk or not. For example, here you can see this in the definition of operational risk for insurance companies from Solvency II. Here it's stated, reputational risk arising from strategic decisions, and risks actively assumed in the context of insurance products are not covered by operational risk. In some textbooks, in some definitions, reputational risk is included and is considered to be an operational risk, but I would leave it out just like a strategic risk. Okay. Now, the most important difference to this earlier conception of op risk is that it's no longer based on a residual. It's no longer based on a distinction from other types of risk, but on an explicit listing of the most important causes for a resulting loss. Thus, especially general business risk, as well as reputational and legal risks, they do not belong to operational risk. Legal risk, in the solvency, it is included. Sometimes legal risks are not included, because then you could make the case that there is always an underlying business or an underlying transaction that causes legal risk. So it might be a trading transaction, might be a trade, might be a loan contract, and this is where the legal risk stems from. So what are the usual characteristics of operational risks? Very high claims amount. For example, you have a flood, you have a storm, you have an IT failure, and if this happens, you have a huge problem. So if your IT system fails, if you have a natural disaster, if your banking headquarters is flooded, usually you will incur very, very high losses. But on the other hand, you have a very low probability of occurrence. It's the probability, for example, of having a power outage, the probability of your IT system failing completely. And as a result, high claims, very low probability of damage, and thus very difficult to measure. That makes it very difficult. Let me give you one pretty good example, which shows you, first of all, what an operational risk is. Second of all, this is a very intuitive example because it combines so many types of operational risk. And you can also see this is a once-in-a-lifetime event. It's again the collapse of Barings Bank. You can see from Barings Bank how many different factors interacted and led to this failure of the bank in the end. And first of all, you had a lack or failure of internal risk control procedures. Remember what happened? You had a single rogue trader who kept two different accounts, one for profits and one for losses. And what happened is that the rogue trader, he wasn't checked. There were no internal control procedures, no processes in place, no limit systems that checked the illegal behavior of this rogue trader. So first of all, inadequacy or failure of internal procedures. Second, as a result, you had illegal behavior of a single employee, of a rogue trader. And then you also had the occurrence of an external event, the Great Hanshin earthquake in Kobe in 1995, which led to the downfall of Barings Bank, because then the rogue trader, who wasn't checked, who wasn't controlled, who traded on his own account and piled up huge losses, the external event exposed this and led to even higher losses. So you had three different types of operational risk combined, leading to this huge failure. So that's operational risk. Next, let's turn to actuarial risk, which is completely different, only to be found in insurance companies, but I wanted to mention this here because this is called financial risk management and not just banking risk management. It's very special. It only appears in insurance companies, and for insurance companies, it is usually the main source of uncertainty and the main source of risk exposure. Why? First of all, we need to be clear what actuaries are. Actuaries are experts in insurance and building society business or pension provisions, and they use mathematical statistical methods of actuarial mathematics or actuarial science to model, assess, and manage risks. Building society is in German Bausparkasse. And as the name suggests, actuarial risk relate to questions of the actuarial modeling of claims and premiums. Now, if you, for example, have taken the class in insurance and financial mathematics, the introduction, you should probably know that insurance business can be summarized very, very simply. And actuarial modeling and insurance business is quite simple. On the left-hand side of an equation, you have your premiums. On the right-hand side, you have your losses. And assuming that you include a slight, let's say, let's call it M for margin, assuming that you want to offer a fair premium and a fair insurance contract, you can easily show that this is very simple. You need to calculate the expected value of your premiums and the expected value of your losses. Now, the premiums are not stochastic, so actually we don't need the expected value here. You simply set the premium. For example, you can say 200 euros for health insurance, 300 euros per month for an health insurance. What is stochastic is the right-hand side. The losses are uncertain, and you have to model the losses, and then after having modeled your potential losses in your portfolio, having taken the expected value, and you need to discount this, then you can calculate your premium. So that is actuarial modeling in a very, very simple nutshell. You need to know your losses from your portfolio of insurance contracts, and you need to take the expectation, you need to discount this, and then you can set the premiums and include a small margin so that you make a profit. But this is obviously not as simple as this looks like, because you need to model the losses, and every failure you do here in modeling your potential losses will lead to higher profits. Then probably someone else from the competition will pick up the business. Or if you have set the premiums too low, you will go bankrupt. So actuarial risk describes the possibility that a model or assumptions made in the model for the calculation of the risk adequate insurance premium is not close to reality or delivers false results due to unforeseeable external events. If you have a portfolio of insurance contracts, let's say bike insurance, bike theft, and you pick the wrong model, then this will be higher than your premiums in total, and you will go bankrupt. So that's actuarial risk. If you're not able to adequately model your potential losses to calculate your insurance premium, that's actuarial risk. And such a miscalculation of premiums often arises from an underestimation of the likelihood and the level of potential claims. Especially in non-life insurance, you're interested in the losses and, let's say, the number of losses, the number of claims. So how big are the losses and how many losses do you have? So what you need to do is improve the estimation of the loss distribution and continuously review and revise your actuarial forecasting models for the expected insurance claims. And this again is specific to the insurance sector, so we're not talking about this in detail, but as you can see, it's closely related to what I want to discuss with you next. To what extent could the results on actuarial risk also be relevant for non-insurance companies? Well, model risk. As you've seen here, actuarial risk is the risk that you pick the wrong model or that you pick the right model but use it wrongly, in the wrong manner. That's more generally model risk, and this is also relevant to banks. So we'll talk about model risk next. What is model risk? Model risk can be understood as the generalization of actuarial risk to not just only insurance companies, but also to banks, other industrial or financial institutions and companies. They both arise from an inadequate modeling of possible losses. And as we've seen, one central task of risk management, financial risk management, is to identify risk and to pick the right model and to adequately measure financial risks. If losses arise, then it should be picked up in your risk measurement. It's not that we can prevent all losses from happening, but we want to make sure that our models forecast those potential losses. So if we are wrong, if we incur higher losses than expected, it could be that we haven't identified all risks. It could be that we simply had bad luck, but it could also be that we simply picked the wrong model, that we have inadequate risk modeling, and this is model risk. So in a very simple example, the risk manager could have chosen a model that is fundamentally unsuitable for estimating the potential losses, but even a model that is well suited, the right model, can be calibrated using false data, erroneous data, could be used with the right data but with wrong parameters, with the wrong estimation of parameters, or even the right model with the right parameters, with the right data, could be misinterpreted. If the risk manager doesn't know how to use this model, could be that we have the right model for the right purpose with the right data, but still you make the wrong conclusions. You take the wrong conclusions. So model risk is the risk that a company suffers a financial loss from the use of a model that shortens reality or the incorrect calibration, estimation, or use of a model. So first of all, a model by definition always shortens reality. It wouldn't be a model if it depicts reality at 100%. Then we wouldn't need a model. A model always simplifies, but it could be that the model simplifies too much. It leaves out certain aspects of reality that we need for a proper risk measurement. or we calibrate it wrongly. We have the wrong estimation or the wrong use. So let's look at some different types of model risk. We use it in the wrong way. Model has a different purpose, generally unsuitable for the intended purpose, or it's incorrectly specified. Very simple errors, a programming error, technical errors, a cause approximation, then the model is right, but it's incorrectly implemented, or we have the wrong use of the data model. We have data problems, overfitting, underfitting, incorrect model calibration, overinterpretation of the results. So what is the model capable of and what it is not capable of? Might be that we overinterpret it. So which examples of models can you think of where model risk can arise? Well, if you've taken the class on financial derivatives, you probably know that you have pricing models. And if you take the wrong pricing model, have the wrong assumptions in your pricing model, then of course these models can cause model risk. So wrong pricing model for securities, especially derivatives, inaccurate estimation of market indexes and market figures, volatility, correlation, variation of these indexes, forecasting period is too long, simplifying assumptions, no transaction costs, liquidity costs, a risk-free interest rate, random walk assumption, some data errors, especially in high-frequency data. It's not so much a problem in low-frequency data, in daily data, but in high-frequency data, data errors might occur. General overstraining of models and excessive complexity of certain tasks. For example, we want to model and forecast tail events, determining systemically relevant financial institutions, and we want to forecast the S&P 500 for the next 10 years. That's not possible. We don't know where the S&P 500 will be in 10 years, so this is a general overstraining of models. Okay, so what can we do to limit model risk? First of all, use multiple models. Use more than just one model and try to interpret the differences. Look at worst case, best case scenarios. Use a model averaging approach. So you take different models and you take the average. You try to quantify model risk using a benchmark. You can consider limiting cases, extreme scenarios, and stick to the concept of parsimony. If you have several models that can explain a phenomenon, use the model with the least assumptions, the least and the lowest number of parameters, because by increasing the number of parameters, you are prone to make the error of overfitting, and then of course do back and stress testing, which we'll see later on. What is backtesting and stress testing? Backtesting refers to the process of evaluating a risk model by applying the model on historical data and checking the adequacy of the model. You can then see if you've done something wrong, if your results are not satisfactory, and if you've seen that those results are not satisfactory, then you should adapt and correct the model on the basis of the result and try to identify those weaknesses. For example, you forecast share price returns, you backtest the forecast with historical data, and if you see that you have too high deviations between your forecasted returns and the historical returns, then something's off and you should check your model. Stress testing is closely related to this. It's the investigation of the effects of changes in risk factors using scenario techniques on specific key figures. For example, you change some parameters, you also use maybe a stress test scenario, worst case scenario, and then you see how your model fares under this stress test worst case scenario. And we can make a distinction between a micro and macro stress tests. Micro stress tests are concerned about an individual institution. Macro stress tests are done by, for example, the European Central Bank to check the stability of the whole financial system in the European Union. Okay, so this is a short introduction to the different risk types. As you've seen, it's usually based from the Basel regulation in banking. It's credit risk, market risk, operational risk, and liquidity risk is somewhere in between, but of course it's also relevant for banks. Actuarial risk is not as important, but model risk is, and there are some very interesting types and discussions of model risk. I can only, if you're interested in this, look at the page I hope I'm writing this right. It's Jon Danielsson at LSE. He has a very interesting blog on risk management, and he's also written a number of papers on model risk, and he has some very interesting thoughts on endogenous risk. Endogenous risk being the case when you do something in risk management and the things you're doing in risk management actually causes the risk. So it's a paradox, just like the chicken and the egg, and you see a risk, you do something in risk modeling, and actually you're worsening the situation. So that's very interesting, and you can have a look at his blog. Okay. So these are the most important types of risks, and then let's continue with the identification of risk factors, a little bit of quantitative risk management. So we'll start with risk measurement now. We've identified all our risks, and we want to measure our risk exposure. Now, for modeling purposes, it is important to know that we have so-called elementary risk factors, elementare Risikofaktoren. Why is that? Well, in the end, we have a change in the security price, for example, or we have a change in the default probability, but it's not that the price itself is changing. Usually something underlying the security price changes. For example, expectations about the future prospects of this company, interest rates, the GDP outlook, business sentiment, anything that will have an impact on the security price might have changed. And these are the elementary risk factors that cause the change in the security price. And this is what we're trying to do now. So we'll model uncertainty with the help of a so-called probability space, in German Wahrscheinlichkeitsraum, on which we define all our random variables. Now, you don't need to know what a probability space is in detail. It suffices to say, I think I have a definition here, it's simply the mathematical framework to say, well, this is the underlying reality. Yeah, this is reality. It's a probability space where we have it's a triple, it's the sample space, the set of all possible outcomes. So this is anything that can happen, any states in space. Then we have a so-called sigma algebra, the set of events, die Menge der Ereignisse. So anything that we can define in reality, which might carry a probability. And then we have the probability measure, das Wahrscheinlichkeitsmaß, P, which simply sticks a probability to anything defined in the sigma algebra. And we need a special structure. We call this a sigma algebra because it allows certain operations, adding probabilities, taking the intersection of two events, and so on. And this is simply the basic tool in probability theory, in mathematics, in statistics, stochastics, that we need to define random variables. I'll say this in German because I think this might be unclear for those German native speakers. Das ist ein Wahrscheinlichkeitsraum, und auch wenn das auf den ersten Blick ein bisschen umständlich wirkt und man irgendwie keine Ahnung hat, was damit eigentlich gemeint ist, das ist einfach der mathematische Rahmen, in dem man Zufallsvariablen definiert. Ich gebe Ihnen, oder das Beispiel mache ich vielleicht gleich nochmal auf Englisch, aber am Ende ist es letztlich so, Sie müssen ja sagen, irgendwas passiert in der Welt zufällig. Und da haben Sie Zufallsvariablen. Aber wir arbeiten ja hier mit Wahrscheinlichkeiten, wir arbeiten mit Risiko, und in der Stochastik sagt man jetzt nicht einfach, alles ist zufällig, alles kann passieren, sondern Sie sagen im Grunde genommen, die Umweltzustände, die kann ich klar definieren, das ist Omega. Auf dieser Menge an Zuständen kann ich jetzt Ereignisse definieren, die dann bestimmte Rechenoperationen ermöglichen müssen. Sie wissen, ne, Sie haben in der Wahrscheinlichkeitsrechnung gesehen, ich habe zwei disjunkte Mengen, zwei Wahrscheinlichkeiten, ich habe dann auch die Schnittmenge und ähnliche Sachen. Also diese Operationen müssen auf f erlaubt sein, und weil das letztlich hier eine Menge ist, auf der Rechenoperationen möglich sind, nennt man das eine Algebra, und eine spezielle Form, nämlich die Sigma-Algebra, da sind dann bestimmte endliche Vereinigungsmengen und ähnliche Dinge, das ist dann erlaubt. Ne? Dass also, ich meine, eine unendliche Vereinigungsmenge und eine endliche Schnittmenge, die sind dann wieder auch definiert und die müssen auch in f drin sein. Dann haben Sie eine Sigma-Algebra. Und P ist nichts anderes als einfach Ihr Wahrscheinlichkeitsmaß, dass Sie jedem Ereignis in f eine Wahrscheinlichkeit zuordnet. Und damit können Sie nämlich sagen, okay, ich habe jetzt quasi die Realität, habe ich hier in dem Wahrscheinlichkeitsraum aufgefangen. Ich weiß es nicht, ich kann das nicht beobachten, aber ich kann auf diesem Wahrscheinlichkeitsraum Zufallsvariablen definieren und letztlich die Realität offenbart sich über das, was in den Zufallsvariablen aufgezeigt wird. Und ich gebe Ihnen jetzt mal ein Beispiel. I'll give you an example where you can see this very nicely. You take a dice. I think dice is the singular, sorry. You take a dice. And without throwing it, you know that the potential outcomes are 1, 2, 3, 4, 5, 6. Why do you know this? Because you have a look at, you can have a look at this. But if I were to show you, well, I have a dice in my hand, you probably wouldn't know, or you would. Let's make a different example. I take a dice into my hand, and you don't know whether it's a regular dice with 1, 2, 3, 4, 5, 6, or whether it's one from role-playing with maybe, I don't know, 15, 16, probably 16 numbers on it. So I only show you my hands, and I tell you I have a dice. That's probably where you would say, okay, well, I can define the probability space. I know it might be 1, 2, 3, 4, 5, 6, 7, 8, and so on. I have some events in f, and I know that the probability will be 1 over the number of potential outcomes. But then I throw the dice, and you get a random variable. You have a random variable, and suddenly the throw of the dice shows you one result that came into existence that resulted under this probability space. And you can now see that if I throw the dice more and more and more often, that you see more results from this probability space that you cannot observe directly. And then you see that you can, at some points you have an idea of what the probability measure looks like, you get an idea of what the set of events looks like, and then that's your random variable. So this is why we need a probability space in mathematics to model the underlying reality that is not directly observable, the random behavior that is not random, that is not directly observable, but only through the results of a random variable. So this is where we start. We have our probability space. We define a random variable, RV, random variable, V, for the value of an investment on our probability space, and V is the value of our investment. Could be a stock. So for a given horizon, time horizon, delta, let's say 1 day, we can immediately calculate the loss from our investment. That is VS plus the time horizon minus the initial value. So the change in the value is a loss. If, for example, we say, well, we started out at, oh, sorry, this is the wrong one. Let's say we started out at 100 and the price is now 80. You can see that we get a loss of 20. And note that the loss is defined as a positive number, so we would have minus 20 here, but we switch the sign so that 20 is a loss and minus 20 would be a profit. Now, at the point of time in the end, the loss is observable and is no longer stochastic. However, today at time s, the loss from the investment is random and it's stochastic. So this is how we define, first of all, our loss distribution. The distribution of those potential losses going from S to S plus delta is referred to the unconditional loss distribution of the corresponding investment. And in contrast, if we take L and model it under the condition that all information until time is known, there is one space lacking here. There should be one space here. Then it's what we call a conditional loss distribution. The difference is that for conditional loss distributions, later on we'll need a conditional model that is a time-varying model, like a time series model. For unconditional losses, we simply take, for example, a normal distribution, a t-distribution, and so on. Now in practice, the term P&L is often used, profit and loss distribution, because as we've seen here, this could be a loss, but if we have, let's say, 120 here, we would get a profit of minus 20. So if we take the distribution of profits and losses, we call this the P&L, the profit and loss distribution. If we cut off, if we, it's called censor it at 0, and if we only look at losses, then we have the loss distribution. Loss distributions are often used in credit risk modeling. Why? Because the only thing that is stochastic is the loss, and this is very close to non-life insurance where you have only losses. The insurance company doesn't get more money if your bike is not stolen. It only loses money and only can have a claim of a positive number or, in the best case, 0. So this is why we use positive loss distributions in non-life actuarial science or also in credit risk. Okay. Now next, we use equidistant points in time. We don't use S plus delta, but we say t plus 1, t plus 2. So what we get is minus vt plus 1 minus vt. Value tomorrow minus value today is the daily loss or the daily profit in our investment. Now S often refers to the number of years, number of days. So we can also use delta being 1 over 365, 1 over 250 trading days. And I only wanted to mention this, that in practice it is often very interesting and very important to use the so-called day count conventions, especially when you have to calculate interest rates and when you have interest payments and when you have to check on which day should I transfer my money. So you can use actual, that is actual number of days in a month, actual number of days in a year, or 360, actual 360, actual 365 fixed, only differs from actual in leap years, in Schaltjahren. And then you can also use business day conventions to make sure that, for example, you don't miss a payment. If you need to pay it and transfer the money on Friday and on Monday, this is of course in practice very interesting and very important. I haven't seen any research articles on day count or business day conventions so far, but this is rather important in practice. Okay, so we have two random variables, R Vt and Vt plus 1. Vt is known. Lt plus 1 represents the loss from moving from t to t plus 1. And up to this point, we've only considered the value of the investment itself. And we now go one step further and one step deeper. We want to know how Vt comes into existence. And the value is obviously a function of time and a d-dimensional random vector zt1 until ztd that captures different risk factors. So Vt is a function f of t and zt, and f is any measurable function. We don't need to care about this, but this is important. So the value is a function in time and risk factors. Very simple. For example, if we have a stock investment, zt could be a risk factor, business forecast, analyst forecasts, general business outlook for the industry, for the sector, and so on. So risk factors are usually observable at time t, and the choice of risk factors is a modeling test. So if, for example, I were to give you a very simple European stock option, what are the risk factors? Well, one simple way is to think about this in the following way. You have a pricing formula. We'll see this later on in the lecture. We've already seen this in the first lecture, I think. The Black-Scholes pricing model. And from the Black-Scholes pricing model, we know that which parameters influence the price and thus the value of a stock option. What we have is interest rate R, maturity, so time, not really a risk factor because we've seen that in the value function, its value is depending as a function on time and risk factors. But we have interest rates, maturity, current stock price, and we also need volatility. Let's call it vol. So these are the risk factors: interest rates, current stock price, volatility of the underlying stock that will influence the price, the value of the stock option. So here you have a non-trivial example where this is a function in t and zt. And this is what we call risk mapping. Risk mapping is this function f, which specifies the relation between the value of a position of an investment and the underlying risk factors. If you take a different pricing model, you will get different input parameters, you will get different risk factors, and you will have different risk mapping. So risk mapping maps elementary risk factors to a pricing formula, to the value of an asset position. And we'll have some examples now. I've already given you one for the Black-Scholes model, so let's have a look at those risk mappings. Now, first of all, we still want to measure risk. So we have an investment, we want to measure risk, and what causes the changes in risk are actually changes in risk factors, because changes in risk factors will lead to a change in the future value of our position, and this will be a profit or loss. So thus we define xt as the process of changes in the risk factors. And again, zt, think about this, this zt could be volatility or an interest rate. And then this change here, xt, is simply the change in volatility, zt minus 1. And the mapping we've seen in equation 1 can then simply be written as the loss, this is stochastic, remember, the loss tomorrow is given as a function, the risk mapping, tomorrow, risk factors known today, they are deterministic, plus the change in the risk factor minus today's value. And this is deterministic, this is deterministic, this is, and as you can see, the only thing that is stochastic is the change in the risk factors. That's the only thing we need, and thus the loss distribution will only depend on the change in the risk factors xt plus 1. So what we need actually, we need forecasts on the future change in volatility, the change in the current stock price, P or S, the change in interest rate, the change in the probability of default for a loan investment. We need the change in, what else do we have? The change in GDP growth. What is our business outlook for the whole economy, GDP, and so on. And these are our risk factors, and we need forecasts for the future evolution, time evolution of those risk factors. We now define the loss operator, and I would say let's leave this out. You don't need to know this. It's simply a generalization of what we've written here, that your loss is a function in the changes in the risk factors. Okay. Now, if your risk mapping is differentiable, also differenzierbar, we can have a look at the following linear approximation of the loss function. So we approximate the loss function linearly by doing this: minus partial derivative of f with respect to time plus the sum of the partial derivatives of f with respect to the different risk factors. This is actually quite simple. If you take this, let me delete a little bit here. If you take this equation, and if you calculate the first derivative, you can calculate and you can see that you need the partial derivatives, and actually this is the same as in high school. You calculate the total differential of this. Okay, so this is the linearized loss operator or loss function, and this is an approximation. Might be good, might be bad. So the linear approximation has the advantage that a loss can be indicated as a linear function of the changes in risk factors. However, the quality of the approximation highly depends on the question whether the function f itself was close to being linear or not. And this is the case if the second derivative, f bar dash dash, vanishes. Okay. Next, let's distinguish conditional and unconditional distributions. Again, conditional models, sometimes called dynamic models, sometimes also referred to as time-dependent models or time-varying models, they look at the conditional distribution of xt under the condition that you have incorporated all information up to point d minus 1. And this is the distinction between conditional and unconditional models or distributions. If you have a conditional one, you will usually use a time series model. If you have an unconditional model, that's usually just a regular Gaussian model. So if we now fix time, and if we look at the sigma algebra ft of the information available at time t, so one calls this sigma algebra, and what happens is you look not just at a distribution conditional under, let's say, a set A, also bedingte Verteilung von A unter der Menge A, von F unter der Menge A, von X Schlange. Anstelle von, instead of A, you can also use a sigma algebra like F script. So you don't use a set here, but you use a so-called sigma algebra. And then you again get a conditional distribution. This is what we can see here. And it's simply a generalization of saying, well, let's look at the distribution of x under A, for example. That's simply a generalization. And this is the stochastic model for the idea that every time you have one day of additional data, you have to adapt your model to this new information. And this is also why we call this the sigma algebra that is generated by XS. You don't need to remember this, but if you ever see this, or if you're studying economathematics, financial mathematics, then you probably know what is meant by this. Okay. So obviously, this conditional distribution here is not necessarily equal to fx, to the unconditional or stationary distribution. Das ist auch klar, dass also die bedingte Verteilung von f von xt plus 1 ungleich dieser stationären oder unbedingten Verteilung von x ist. Okay. Later on, we'll talk about so-called gauge models, very famous time series models. They can be used, and these are examples of conditional models. Okay. Now, if we take a look at this here, again, this is some real data, I think, from the DAX 30, and you see we have more volatility here, more volatility here, more volatility at the 2000s, and then it starts again in the financial crisis, I think this should be the financial crisis. So what you can see is this would be an unconditional distribution. Yeah? You have the same amount of, you have no trend, you have the same amount of volatility over time, and this here is definitely not an unconditional distribution because you have time varying volatility and you need a conditional model. Okay. So let's discuss the advantages and disadvantages of conditional distributions. Advantage is definitely you can model volatility clusters. You can model more realistic phenomena and stylized facts of capital markets and financial markets data. Problem is that these models are obviously more complicated. They are more powerful, and they also come with a higher model risk because you have more models at your disposal. Yet you have more different parameters, and model risk will be higher for those conditional models. Okay. We can now look at the conditional loss distribution, which is simply defined as the probability of the loss being smaller or equal than L under all available information, conditional under all available information up until T. This conditional loss distribution is thus the conditional distribution of the loss in the next time period, provided that the information Ft is given. We also have the unconditional loss distribution, FLT plus 1. And the unconditional loss distribution is of particular interest if we can neglect changes in the distributions of the stochastic variables of interest over the course of time. Sometimes the case for some commodities and in credit risk modeling. Then in these cases we sometimes use, or in many cases we use an unconditional model. Just to be sure, if we use a conditional model, we call this often a dynamic risk management, and you never hear this word static risk management, but in all other cases, if it's not dynamic, you use an unconditional model. Okay. Some examples for risk mappings. First of all, the example of an equity portfolio. We have a portfolio that consists of D stocks. Lambda I denotes the number of stocks in the portfolio. The stock prices are modeled using STI, so S for stock. From the stock prices, we first derive the logarithmic prices as risk factors. So we make a very simple assumption. We simply say the risk factor that drives our value is the return. Thus, the changes in the risk factors are given by log price minus log price, and actually this is the future log return. So that's the risk factor, the only risk factor we are looking at in this very simple example. Now the value of the portfolio is given by the sum of all the numbers of stocks we hold times exponential function of the risk factor, that is the weighted sum of the prices, and you can see that exponential function of ZT is exponential function of the logarithm of STI, and this is simply again the price. So we could have also simply written lambda times STI. The loss over time is then given by LT plus 1 per definition minus VT1 minus VT, and then we have minus the sum over all stocks in the portfolio weights times STI times the exponential function of the change in the risk factor minus 1. So in linear approximation we get the following. You can simply take the derivative here, and you will see that in the end you have the loss linearized is minus VT times the sum of the weighted risk factor changes. This first derivative with respect to time vanishes. The derivatives f, z, I all add up to VT, and the weights are lambda I STI divided by the overall initial value of your investment, and these weights equal the share of the portfolio value invested in stock I. So what you can see is it's actually portfolio value, initial value, times the weighted sum of these xi's And we can now assume for the risk factors a very simple distributional structure, a multivariate normal distribution with mu and sigma being the expectation value, a vector of expected values, and the variance covariance matrix. And what you get is actually expected loss is given by the squared value of the portfolio times the weighted variance covariance matrix. So you only need those variance covariances, and then you get your expected, the expected return or expected loss and the variance of the return. And then you can model the distribution. Second example is a little bit more complicated, and we've talked about this in short. Let's consider a portfolio that contains plain vanilla options. More precisely, a European call option on a non-dividend yielding share S with maturity T and a strike price of capital K. For the pricing of the call, we use the Black-Scholes model, and then from the Black-Scholes model, we know that the price should equal stock price times phi of DI minus strike discounted times phi of D2. D1 and D2 are defined by this, and we see that in the end, actually the value is a function in the change in time, the stock price, the interest rate, volatility, the strike, and T. The changes in the risk factors are then given as the log return of the stock, the change in the interest rate, and the change in volatility. Everything else is known and is deterministic. Okay, so we have three risk factors that we need in our risk mapping: log return of the stock, change in risk-free interest rate, and the change in the volatility. Then linearized, it's the partial derivatives of the Black-Scholes formula, and as you can see, we suddenly are confronted with partial derivatives of the Black-Scholes option pricing formula. They actually are proxies for the risk factors in the linearized loss of the European call option, but they also show you the sensitivity of the option price against the model parameters, and that's why they get a special name. Those partial derivatives, they are called the option Greeks. For example, the sensitivity to changes in the share price is called the option delta. The sensitivity to time is theta. The sensitivity to interest rate changes is rho. And the option vega is the sensitivity to volatility. And there are some further partial derivatives that are not listed here, but those are the most important ones. The option delta, theta, rho, and vega. And why do they have special names? Well, because as you can see here, if we take the log return, the change in the interest rate, and the change in volatility as those elementary risk factors that drive the loss from an option investment, and if we now linearize it, you can immediately see that this is where those option Greeks suddenly pop up. Those are the option Greeks. And here. Those partial derivatives are part of the linearized loss, and that's why it's so important. How would you rate the quality of the approximation? Well, that's the problem. The option pricing function is highly nonlinear. And if we use a linear approximation to a nonlinear function, the approximation will probably be not good. And that's the case here, so you have to be careful when using a linear approximation with a non-linear pricing formula. Next example, we consider a portfolio consisting of D risk-free zero coupon bonds, could be government bonds. Maturity is TI, prices is P of S and TI, time is again given in years, and lambda I is now the number of bonds with a maturity of TI in our portfolio. Then let Y of ST be defined as -1 over T minus S times the logarithmic price. That's the yield of a zero coupon bond with constant interest then we get the following. The price of the bond is given by the exponential function of minus t minus s times the yield. And this mapping of the maturity to different yields is referred to as the yield curve or the interest rate structure, die Zinsstrukturkurve oder die Yield Curve, auch auf Deutsch so benannt. And this is quite important for the pricing of a bond portfolio. Now, if you take a look at the R package yield curve, you can actually extract the European Union's yield curve at different points in time in 2006, 2009. You can see this is the maturity in years, and this is the interest rate. And you see at this point, for example, in 2009, we started out at a short-term interest rate of 0.5%, 1%, and we had price interest rates up to 4.5%. Looks different now, but you can have a look at this at the R package yield curve. This is also a practical example taken from from Börse Stuttgart. You see those yields, or in German die Renditen, for different maturities here, for different maturities up to 10 years. It's a little bit older, we still had interest rates and yields of up to 4% at that point. So what do we need for the risk mapping? We use the returns y of STI as risk factors. Then the value is given as the weighted sum of those prices. Expressed in terms of returns, we simply substitute P by the returns. We get weighted sum of lambda I times exponential function of minus ti minus t delta times the yields. And with this, the portfolio loss can be calculated quite quickly. We know we want to linearize this again. And what you get is, in the end, the weighted sum of the portfolio weights times the price times the change in the yield. And then here you have those risk factor changes. Everything else is at point t. So this is the change in the risk factors, the change in the yield from t to t plus 1. And if we now take a look at the special case of a flat yield curve, that is, all those yields for different maturities are flat. That would be the case if, for example, it looks like this. Then for different maturities, we always have the same yield here, here, and here. Then we can simply substitute y of st by ys, and we only allow parallel jumps. So the flat interest rate curve can go up and it can go down, but it cannot bend. Then ys plus delta, and what we get is the linearized loss is given by minus the initial portfolio value. Let's use a red pencil again. Yt times delta minus the weighted sum lambda I times the price divided by the overall portfolio weight times ti minus t delta times smaller delta. And this is actually, if we write this as d, as defined here, you see something happening that you might remember from a finance class you've taken. This is actually the duration. This term, d, as the remaining maturity on this payment, and you can see here the weights are actually the amount of money you've put into the ith bond relative to the overall portfolio weight. So this weighted sum of the still outstanding cash flows is referred to as the duration of the bond portfolio. And the duration describes the sensitivity of the portfolio value to parallel shifts in the interest to the yield curve. And thus, if you want to hedge your whole portfolio against any changes in the interest rate, in the yield curve, you would try to get a duration of 0. So that's the duration. And last but not least, we'll consider a portfolio of loans. For example, bank loans. We are now looking at a portfolio of loans with M counterparties. The notional value of each credit and each loan is, let's call it loan, is EI. E is for exposure. Lambda is set to 1 year. And we assume that all loans will be repaid at time capital T and that there are no early partial repayments. Then Y of TI is random variable that takes on the value 1 if the borrower has defaulted and 0 otherwise. So we have credit risk in the form that a loan can default or it will not default. We also, for simplicity, assume that the recovery rate is 0. So if it's lost, it's lost. So to start the valuation, we'll need to look at the loan's cash flow. The loan is exposed to default risk, and we have to discount the cash flow EI with the risk-adjusted interest rate. So more specifically, we use the risk-free interest rate plus a risk premium. And then the value of the loan is simply given by exponential function of minus t minus capital T minus t, with the yield, that's the risk-free part, plus CI, that's the loan-specific credit spread, the risk premium we are putting on top on our risk-free rate. These risk spreads, those credit spreads are often calculated using corporate bonds, and we have more formal models that are used to derive those risk premiums. But now it suffices to say that we use the risk-free rate plus a credit spread on top. So further, we simplify the model and assume that all the loans have the same risk premium, that all the credit spreads are equal. So we lose the index I, the subscript I. And in summary, we get for the value of the credit portfolio 1 minus YTI times the exponential function of the discounted credit exposure. So let's have a look at this. This EI is, for example, the exposure. We have given out a loan of 100. Then we need to discount the 100 euros. That's what we are using this for. But we are not simply using the risk-free rate. We need to include a credit spread, which is maybe plus 1% for credit risk. And the value is only positive and is only non-zero if it is paid back. So if we have a default, there will be 1 minus 1, so this is 0, so the whole term will vanish from our sum. If it not defaults, then it will be 1 minus 0, and the whole discounted value of the loan enters our portfolio value. And thus we can summarize the risk factors. We have all those different default indicators. We have the risk-free rate and the credit spread. So we have 3 types of risk factors, elementary risk factors: default probabilities, risk-free rate, and the credit spread. And then the loss can be calculated using this value function and this pricing function. Okay, so obviously from the simplified model, even from the simplified model, we need a joint distribution of default rates and maybe including the risk-free rate and the credit spreads. And this is what we'll discuss later on. But you can see you need the joint distribution of ZT, and this includes those default probabilities. And it could be, for example, if Deutsche Bank defaults, Daimler-Benz defaults as well. So there will be dependence between YT1, YT2, YT3, and so on. So there will be interdependence between the risk of default in your portfolio, and they will not be stochastically independent. So that's why we need a joint distribution model. Okay, so that's everything when it comes to risk mappings. And next we'll talk more about different types of risk measures and how to measure risk in a portfolio. If you don't have any questions, you can wait again until I stop the recording. If not, thank you very much for your attention and see you next week. Thank you.